Welcome to this brand new explainer. Today, we've got a really fascinating financial puzzle on our hands. AZZ Inc.'s Q1 2026 SEC filing. We're going to dig straight into the numbers and uncover the true narrative that's hiding inside these spreadsheets. Let's get to it.
Now, for those of you who might just be getting familiar with the name, AZZ Inc. is an absolute powerhouse in the manufacturing sector. They're a major provider of hot-dip galvanizing and coil coating solutions all across North America. Honestly, if you see durable steel structures out in the world, there's a really good chance AZZ had a hand in protecting them from the elements. But today, we aren't just looking at the metal, we're looking at the math.
And that brings us to the central question for this explainer. It's the ultimate financial mystery, really. How exactly does a company make more money from its customers, but simultaneously report a cliff dive drop in net profit? I mean, it sounds completely counterintuitive, right? Well, the answer is buried deep in the SEC filing, so let's extract it together.
Section 1. The earnings mystery. Rising sales, falling income. Okay, let's start by laying out the evidence and looking at the top line, the sales. Things look incredibly healthy here. In the first quarter of fiscal 2025, AZZ brought in $421.9 million. Fast forward to this newly reported first quarter of fiscal 2026, and those sales actually grew to an impressive $448.5 million. That is solid, undeniable top-line growth. Basically, people are buying more of what AZZ is selling.
But here's where the plot thickens. Let's contrast those rising sales with the stark reality of the bottom line. Net income absolutely plunged from $170.9 million last year down to just $52 million this year. Ouch! From a quick glance, you might panic and think profitability literally just fell off a cliff. But, we need to look a little deeper.
Section 2. Solving the income drop. The AZZ anomaly. So we have to solve this income drop before we can accurately judge the true core health of this business. And the culprit behind this wild swing? Well, I want to draw your attention to a very specific, somewhat dense line item listed right here, equity in earnings of unconsolidated subsidiary. In Q1 of 2026, that number is a modest $509,000. But look at the column for Q1 of 2025. It is massive.
That's right, $173.5 million. This was a one-time windfall from their 40% interest in the AZZ joint venture. During that specific quarter last year, the joint venture sold off a business group, which resulted in a massive excess cash distribution straight to AZZ. This wasn't recurring revenue from coating steel. No, it was a one-off structural event that completely distorted their baseline for 2025. It just goes to show why you absolutely always have to check the footnotes, because the headline numbers rarely tell the whole story.
So the crucial point is this. When you remove that one-time 2025 anomaly from the equation, the narrative flips completely. The Q1 2026 core operations didn't falter at all. They thrived. Operating income actually improved from $69.5 million last year to over $77 million this year. The business itself is actually making way more money from its core operations. Mystery solved.
Section 3. The twin core engines. Metal coatings versus pre-coat metals.
Right, now that we've cleared away the accounting noise, we can see the really fascinating dynamic between AZZ's two core segments. The Precoat Metals segment actually generates way more revenue, bringing in $238.2 million compared to Metal Coatings' $210.3 million. However, Metal Coatings drives significantly more profit, pulling in $56.5 million in operating income versus Precoat's $41.5 million. It's this brilliant balancing act between a high-volume revenue engine and a highly efficient profit engine.
Let's briefly define these just to understand why they perform so differently. The highly profitable metal coating segment relies on a metallurgical manufacturing process called hot-dip galvanizing. Essentially, they submerge steel into molten zinc, causing a reaction that provides decades-long corrosion protection. It is an absolute necessity for the North American steel fabrication industry, and it commands excellent margins because the value proposition, making infrastructure last for decades rather than years, is just incredibly strong. On the other side of the coin, we have the high-revenue pre-coat metal segment. This is all about coil coating. It involves cleaning, treating, painting, and curing metal coils while they're still flat, way before they are ever cut or formed. It really emphasizes sustainability, optimizing waste through highly efficient film control. It churns out massive volume for industries that need pre-painted metals at scale, which is exactly what drives that massive top-line revenue number we saw earlier.
Section 4. Who is buying? The customer breakdown.
So we know how they make their money, but who's actually buying? Well, out of the 448.5 million in total sales, you can instantly see that while AZZ is diversified across multiple sectors like transportation, appliances, and industrial applications, there's one piece of the pie that absolutely dwarfs the rest.
That giant slice belongs to the construction sector, coming in at an astonishing $258 million. I really want to emphasize the absolute dominance of this sector for AZZ. Construction accounts for more than half of all total sales across the entire company. If you want to understand the future health of AZZ, keeping a super close eye on the broader North American commercial and industrial construction market is absolutely critical.
Of course, they aren't entirely dependent on just one sector. Their secondary drivers provide a very healthy safety net. Infrastructure brings in almost $56 million. Industrial adds $40.5 million, followed by transportation and HVAC and appliances. These secondary markets prove the total versatility of their coatings. Whether it's an air conditioning unit or a highway guardrail, AZZ has a hand in it, even if they remain much smaller than that primary construction engine.
Section 5. Strategic Expansion, Canton Galvanizing, and Beyond.
So how are they deploying capital to grow? Well, the SEC filing outlines a very strategic acquisition completed on July 1, 2025. AZZ acquired the assets of Canton Galvanizing, a privately held hot-dip galvanizing company based in Ohio, for approximately $30.1 million. And this wasn't just a random purchase, right? It was a targeted move to expand their geographical coverage and significantly strengthen their network of facilities right in the heart of the Midwest region.
Let's actually break down the financial jargon of the purchase price allocation, because it tells us exactly what they truly bought. Sure, they got $4.7 million in physical property, plant, and equipment, but the real prize? $13.8 million is categorized as intangible assets. The filing specifically notes that these intangibles are amortized over 15 years and consist of customer relationships. Basically, AZZ didn't just buy vats of molten zinc, they spent millions buying a guaranteed, loyal, 15-year customer base in a brand new geographic region.
And when you tie this all together in the financial notes, the strategy becomes incredibly clear. Remember earlier how we discovered metal coatings as their absolute highest margin profit engine? Well, this acquisition proves management is pouring money directly into the most profitable side of their business. They know exactly where to invest their capital to get the absolute best return.
Which leaves us with a really vital question. Will this aggressive $30 million Midwest expansion be enough to push next quarter's core net income to new, unprecedented heights? The baseline is reset, the AVAL anomaly is firmly behind them, and the growth engine is totally fueled. This is definitely a balance sheet worth watching closely. Thanks for joining this explainer, and we'll see you on the next one.